All right. Good morning. Today is Thursday, February 19th, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our social media pages. If you are here with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor, and I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, our Chief Investment Officer Consultant, Tom Fox, who we will all hear from in just a couple of minutes. We also have financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team, Karen Miller, Josh Denny, and Ann Colian. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. And one of the ways that we deliver on that commitment is through today's monthly update. Today's an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see, and ultimately to become a more informed investor. We do this in two ways. One, we can help you see your entire financial situation, both today as well as every year into the future through our personal wealth planning services. If you'd like to learn more after today's message, I invite you to head on over to clearfinancialfuture.com and watch the 2-minute video. We also help our clients get invested right. Being invested right is distinct to every account that we manage. SmartMix is our personalized portfolio solution for doing just that. Whether you have $25,000 or $25 million, SmartMix is our process for helping you get and stay invested right. After today's message, I invite you to go learn more at smartmixportfolios.com. Today, again, we're going to hear from Tom Fox. Tom will review the positives in the markets, the headwinds, and give us his outlook for the rest of this year. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions whatsoever, I invite you to put them in the chat box on whatever platform that you're watching. You're also invited to send me an email directly, or now you can also text our office number, which is 952-540-0153. If you're with us live, I will bring any questions that you submit to Tom at the end of his message. If you're watching in the recording, I invite you to send them anyway, and we would love the opportunity to circle back with you as soon as possible. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has almost 40 years experience building investment strategies. He has an impressive long resume, and as always, I'm very excited for today's message. Again, at the end of today's message, we will have Q&A. So if you're watching online or in the recording, please feel free to submit your questions. We would love to bring them to Tom during the Q&A session at the end today, or circle back with you again if you're watching in the recording. So with that, I will bring our theme for 2026 up onto the screen. Bring Tom onto the stage. Good morning, Tom.
Good morning, Eric.
Thank you for being here today.
Thank you for having me, and good morning, everybody.
So things have changed, and they're continuing to change. One of the big things you've been talking about is increased volatility, and I think we can check that box.
Yeah, I think at the beginning of the year, we forecasted that there would be extreme volatility, and that's what we've been experiencing. I don't think it's going to end today, so I think there'll be ups and downs, and we'll look at the end of the presentation, and we'll see where we're forecasting the market to be by year end. But you're going to need some patience as we make our way through this year.
Sounds good. Well, I'll bring the things we should be worried about to start us off here.
And Eric, there's always lots to worry about, and of course, the market climbs a wall of worry. And we've been talking about this. This has been there for quite a while, but it's elevated valuations. And if we look at the forward PE ratio, which is a measurement of valuation, it's at the higher end. And of course, AR leaders are part of that. And when we look at recently, some techs have come down. Some of the AI leaders that were the big winners last year have come down a little bit. So it's kind of brought it down. But on the other side, the other 493 companies, their PE ratio has gone up because there's been sort of a rotation that has occurred with a breather from tech, and we'll talk more about that. But that's a big one. And I've got a chart that I think will give us some encouragement regarding the elevated valuations. And then we have our AI disruption risk, and we've seen that. Things have changed. And AI models, the large language models where they create all the algorithms to put together our artificial intelligence, is getting, Eric, better and better. In fact, 6 months ago, the LLMs for AI are obsolete. Today, there is parabolic improvements upon these. So what we were maybe using in AI a year and a half ago is already obsolete, and it's been much improved. I'm very much using AI today, and I plan to use it even more. But it's changing so fast, it's amazing. But as what happens, certain companies and certain types of businesses and sectors can be impacted by the AI generation of these new models. And the big one has been software. And potentially white collar workers are going to be replaced or repriced. So there's been some huge disruption. And there's other areas like legal and even some parts of financial services are going to be disrupted. So this is it's an evolving thing that's going on, but it's happening so rapid. So these are worries where the market can go down 30, 40% in a sector because they think AI is going to take over. Anyway, so another risk, of course, is CapEx return, ROI uncertainty. All this money going into AI and all the data centers, are the companies that are investing in these particular data centers and models and chips, are they going to get their money back? And that's a big question out there, and it's still being resolved because there's unprecedented spending going on in AI right now. And then we have market concentration risk. As we saw last year, a lot of the S&P 500 return was driven by just 7 to 10 stocks. And of course, now some of those have taken a breather this year, and there's been some broadening out. That's been good, but there is still a lot of market concentration. For example, the S&P 500 is a cap-weighted index, and you have just a few stocks that are maybe 35 to 40% of its volatility and return. So you can see that a few stocks are generating a lot of the return or volatility. And what happens if some of them don't do well? Well, it could have a big impact on the broader indexes. That's why we build individual stock portfolios. And then the higher for longer. Well, and the minutes just came out with the Fed, Eric, and there were a couple hawks in there, even talking about raising rates. Now, this is not the majority. Most think the Fed is still mildly dovish, and there's not going to be any interest rate increases. But there were a couple of them talking about it. So what happens if they stay where they are? Because the market's forecasting up to 2 more cuts this year. Well, if that doesn't emerge, then that could reprice some stocks. So that's a risk that we're looking at. And of course, we have the geopolitical risk, and we'll talk more about that later. But the big one today is Iran. Is our military buildup outside of Iran is happening, and we're going to see what takes place there. I'm not too worried about that, but you cannot forecast these, and they can or may not have some impact on the market. It all depends. All right, so rising fiscal deficits. This is a big one. Eric, we're still not balancing our budget for our nation. The amount we owe, it keeps going up, and that pushes long-term rates up. Also, it keeps mortgage rates higher. And you can see that it also creates policy uncertainty if there has to be an adjustment. So this is always out there. This is a big one. And there's got to be some plan to reduce our deficit. And then there's a huge optimism, and we're going to look at this. This is bullish, but what if it doesn't happen? What is that? It doesn't become macro reality? Because right now, many are saying that corporate earnings are going up, and more than expected. So, but there could be a disappointment. That's always a risk out there. And then what if the consumer pulls back? I show a chart where that shows the savings rate last year is falling. So people are spending more instead of saving more. And that can't be sustained forever. We'll look at that chart. So there are some risks out there. What happens if the consumer pulls back? There's a lot of talk about the affordability, things like that, and prices going up because of tariffs. And companies are now talking about even raising prices. So they're no longer going to hold back on that to get their margins back up. But we'll see how that shakes out. But that's a risk. And then, of course, the global slowdown. If China catches a cold, everybody gets it. So, and they're sputtering. They've got some issues in China. Europe is kind of stagnant. It's kind of moving now better. It's growing, and actually, Europe stocks are doing okay. But we'll see if it eventually hits our U.S. multinational earnings. We'll see how that impacts that. And then we're into the fourth year now. We had 3 great return years. Well, people can become overconfident or complacent. And what happens if this one sentiment changes? And typically when you have 3 strong years and you're probably expecting another year, that can precede some volatility spikes. So that's another risk out there. So that's the wall of worries that we're looking at. But there are plenty of reasons we should own stocks today. One is the AI-driven earnings acceleration. We're going to see productivity and earnings gains, and we'll see that's later on in this bullet points, but we're seeing earnings accelerate, and it's real. This is not theoretical anymore. We're seeing how AI is helping companies in their revenue growth and also their costs and capital-intensive productivity. So it's all looking very good. And I think it's only going to increase. We'll look at a chart of how many are using AI today. And we're only in the early innings, in my opinion. Okay, earnings are driving returns, not just multiple expansion. So with this increase we're seeing in earnings, well, it's holding the PE ratios where they are, the valuation where they are, because earnings are driving the upward movement in stocks. This is very good. It's a healthier bull market structure. And I think that's going to continue, especially with the influence of AI. And we've just had our 4th print of CPI, which came in lower than expected. 4 in a row have been lower. And we forecasted that the inflation rate was going to continue to drop throughout the year. And so far, we've been right. We've seen 4 in a row now, Eric, come through. And okay, so accommodative Fed, we've talked about this. Fed is likely to lower rates rather than raise rates this year. Again, expecting 2. That's a positive for stocks. CapEx super cycle continues. We got AI, power, infrastructure, reshoring support, multi-year growth, all driven by AI. This is changing everything in companies. And of course, profitability drives stock prices. Then we have the unfolding this year, and we're already probably going to see the beginning of this with the tax refunds and companies have an advantage to invest more, is the one big beautiful bill, lower effective tax rates. You got accelerated depreciation for corporations. And so it should boost free cash flow for companies and again, support higher valuations. So this is all very positive, and that's just beginning to unfold right now. We're at the beginning stages of that new bill. We got strong corporate balance sheets. Remember, during the pandemic, everybody got their expenses in line because of the revenues came down strongly during the pandemic, but then they kept their costs down after going through the pandemic. And of course, now when you build up the other side, the revenue side, that just makes you more profitable as you go forward. And then another thing that's happened this year so far is the broadening of the sector participation. Earnings growth is spreading beyond just mega cap tech. And we're seeing even a kind of a little mini bull within the non-tech companies this year. The old line companies are performing well so far. This is healthy for the long term in a bull market. And of course, we talked about productivity gains from AI, and this is margins are going to expand and so on. And then you've got this multiple secular tailwinds: electrification of America, reindustrialization, defense, and biotech innovation. These are all positive for the overall stock market as we move forward. So there's a lot to be excited about in this market. So where do we stand? Well, AI disruption is going to continue. High volatility is going to continue, and we remain bullish for stocks this year. Now, we have to look at the reality of being bullish for a whole year, Eric, but expect some big downturns. So in the intra-year, we expect the stock market to pull back at some point. Goldman Sachs just put out their probability for an intra-year downturn, and they've got a 99% chance of it following 5%. It hasn't done that yet. They've got an 83% probability of minus 10 and a 50 coin toss of 15% or more. And of course, the lowest is 20%. That would be a bear market. So they're only got a small percentage there. But you can see that their probability, which lines up with history, the average downturn in any year of the stock market is around 14%. It's all this says this should be very normal. And we do expect that volatility have some downturn, but we would look at that downturn as a buying opportunity.
Love this slide.
All right. How many remember our desk in 1981? This is our desk. You can see all the different the calculator and the old screen and computers and all the stuff we had on our desk. That was in 81. Well, there was a revolution in software. And this is where our desk from 81 went. And Eric, I think those are your sunglasses there. But software took away all the need for all that stuff on our desk. Now we got our iPhone, our cell phone, and we got our PC, because the PC can do it all. Well, that's 35 years of advancement of software. But guess what's happening today, Eric? Software is being disrupted by AI. Why? Because AI can now build software. It can code. I heard that Meta has seen such a large improvement in their coders of their software, how that now AI assisted software development can come much easier and less expensive. So as a result, overall technology got hit a little bit. The NASDAQ, which has software companies in it, from its peak, it's down 8%. But look at the software index, which is IGV, it's down 33% because of fears. And I think it's overstated, but I think there's fears that companies will not exist in 5-10 years because of the advancement of AI and its ability to create software for companies themselves and not have to use an outside vendor. Well, this is impacting legal. My daughter's a lawyer and she's using AI, but she's seeing how it's impacting her business. Insurers, wealth management. Eric, we're going to be all replaced by robots. So, no, I think it's in a different area of wealth management.
We had robo-advisors already. That didn't pan out.
We got robo-advisors. Then we have commercial real estates being hit, logistics and freight. All this is being hit by this amazing revolution in AI. So we'll see other groups say, okay, now AI can do this and do that because it's improving at a parabolic rate. Now, this is a chart I think I showed a while back, but it seems to be going along according to plan. Now, this is historically, when you have 3 strong years in the stock market, this is the average. The red line is the average of the 4th year. And you can see that it kind of goes up and down at the beginning through kind of the middle of March, and then it begins to rally, and then it takes a downturn. Maybe that's where we have that correction this year, and then it pops up and goes to a new high. That's what it's done historically. Now, remember, history doesn't follow exactly, but sometimes it does rhyme. Now, Tom Lee put this out, and this is what he thinks is going to happen this year. And if you look at the lines, this is extreme volatility, which we forecasted. Now, it may not do this exactly. Past performance is not necessarily indicative of future performance, but this is something that we think could unfold or something similar. So put your seatbelt on for the year. But at the end of the year, we'll see where my forecast comes in. I think we're going to be okay.
Yeah, I think it's important to add on this slide too that when we're looking at those pullbacks, the 5, 10, 15% pullback, that's from a high. So like as an example in this chart, as you're showing, we could go higher before that pullback and not go any lower than we are today. That would be a scenario.
That is correct.
Right. So it's when we're talking about the 5, 10, 15% pullbacks, I just think it's a good reminder that that is from a high. It's not necessarily from the beginning of the year or any certain date. It's from a high. So,
and I think it was a month ago, but we talked about the 5-day rule and the January rule. If the first 5 days of the year are positive, you have a really high probability of a positive year in the stock market. And if January is positive, you have a very high probability historically of a positive year for the year. And both of them were positive. So you have the 5-day and the January effect. We'll see. It's not 100%, but it does point that typically if you have a good beginning, it's going to be a good year for stocks. But as I've forecasted from the beginning, expect extreme volatility on the way. So here's, earnings are a huge component of why stocks go up. When earnings go up, profits go up, and productivity goes up, you have solid earnings, and this tends to drive is the biggest driver of stock prices. And let's look at what's going on here. This is earnings season. This goes all the way out to 27. In the fourth quarter of 25, we're seeing the results. It's actually coming in much higher than 10.1% year over year. It's going to be in the low teens. So what's happening is that the market is expecting an earnings acceleration to continue. This is good for stocks prices because, again, you don't have to just depend only on valuation or P ratios. You growing the E on the price to earnings, you're growing the earnings. So this is a great, healthy way to extend a bull market. So we have a number of charts here on earnings. Now this is showing 25 each sector what their earnings per share estimates year over year were for the year on the fourth quarter of 25. And what you can see is the dark blue is much lower in almost every case except for technology. But you can see that how broadening out there's the earnings for this fourth quarter that's coming out are showing much better earnings for the different sectors outside of technology. This is healthy and good for a bull market. You want an expansion of earnings doing well outside of just a few sectors in the market. So this is healthy, and this is another good sign. And this is corporations are raising their estimates. And we haven't seen this kind of estimate rising since 2001. It's a long time ago, 24 years ago. So what we're seeing is companies are raising their earnings estimate. They're saying, based on what we see with the AI and the economy and everything that's going on, we're raising our outlook. This is really good for stock prices. And of course, this is the current one. We've had 385 companies report out of the 500. That's 77%. And 76% are beating the estimates. And it's by a pretty large amount. 7.1% is the surprise. That's a solid earnings season we're in right now. And again, it's on a year, quarter over quarter. It's even better than what we saw and what was expected. AI, still in the early innings. This is AI adoption. This is what percent are using AI today. And you can see, Eric, if you look at the lower numbers, that there's a lot of room for potential. I mean, everybody should be coming up to the 80 to 90% or 100%. And so I think we're still at the early starting line of AI use. Many people are still just getting their hands around it. I'm deep into it right now because if I can improve what I do from my end using AI, I want to do that, make better decisions, better stock picks, things like that. I'm using it more and more and learning as much as I can about it. So I'm probably at the higher end, but there are many people still not using it yet, but it's going to increase. So we're early on in the ball game. And of course, this is a productivity advantage of the U.S. A lot of this is going to, GDP per hour's work in the U.S. is right there at the top. Now, if you look at Norway and Switzerland, they have unique industry, so it's really not fair to compare it. But the U.S. really is dominant in GDP per hour's worked, and we see this increasing, especially across the board with AI. Now, this is an interesting chart because it shows AI data center construction versus office buildings. And data centers are about to overtake office building construction. This is amazing. Look at the gap early in 2018 or even 20. But you can see how that's changing, that big gap, and it's going to overtake it. We may see AI data centers overtaking even office building construction.
Pretty incredible.
So the economy, based on what we see, is still resilient. Now, this is an interesting chart by Goldman Sachs, and it shows the median CAPE ratio, which is a valuation measure. Before 1992, this is a type of price to earnings ratio. It's what they've done. It's adjusted for inflation and earnings over 10 years. But it's Robert Shiller's method of valuating markets. You can see back before 92, the average price to earnings ratio using this CAPE ratio was 14. That's fairly low. But the average time that we were in recession is nearly 20%. But look at today. The ratio is up to 27, but the average time since 92, but look at using the CAPE ratio, but look at the average time we spent in recession is only 8%. Because the dominance of heavy industrial and inventory management and things like this, and now we're moving into a services and a technology dominant sectors. What's happening is if we do go into recession, most likely it's going to be very short-lived and will not be as deep because of the potential that companies can now manage all their complexity. Even large caps can be run like a small company because of AI and their ability to see things. Back in the day, let's say a Procter and Gamble, they weren't even sure what they had in the warehouses that were spread out around the world. Today, they know exactly what's going on, and it's even becoming more efficient. So what this means is our downturns in the stock market and even how long we were in a recession, I think is going to get lower and lower and lower. Another positive is unemployment insurance data has shown a few signs of distress. You can see it's been heading down. There was some concern about the labor market. We were concerned about the labor market, but it seems to be stabilizing. We're not seeing signs of distress in the labor market. Some thought it would just move quickly as companies lay off people and AI takes people's jobs. but it hasn't happened yet. And here's another sign of positive in the economy is that private payrolls have been accelerating. So less unemployment insurance, but we've seen private payrolls accelerating. This is all positive, and it's showing that the economy's labor market is not falling off the cliff as some were forecasting. Now, this is an interesting chart. And if you could see, Mark, 2018, Eric, on the left there. Yeah, see that 2018, that's when Powell became Fed chairman. When he came in, the core CPI was 2.2%. But look what the Fed funds were, only 2.1%, 10 basis points higher. Now, we went through that inflation spurt post-pandemic. Now look where we are. We're at 2.52 now. We're not much higher than we were before the pandemic and the big inflation rise. We're at 2.52. But look where the Fed funds are. There it's 3.5 to 3.75. What this means is you could have 2 to 2.25% cuts. That's 7 cuts at 25 basis points. We think there's some room for the Fed to lower based on this chart. I've added one thing in the forecast in the back end, but we'll see. But I think there's still room for Fed to lower rates. That would help the housing market. So I have reasons to worry. Here's the housing market. We're seeing people pull out at record high out of canceling their pending sales because of affordability. There's affordability and the cost of a mortgage today. Even though today I saw it just hit the lowest it's been in 4 years, just popped up on my screen. But it's still based on the last 10 years, very, very high. And of course, we have a lot of expenses going up with affordability, so people can't afford homes. So right now, housing's in a recession, and it's been there for a while. So there's something that needs to happen. This is a problem and can bring stress to an economy. The other thing to worry about, and this cannot be sustained, is households are not saving as much as they used to. This only goes back to January 25, but the saving rate is plunging. What does that mean? People are not saving, and instead they're spending that money, and it has a lot to do with how much they're paying for things they need every day. So this cannot be sustained. We need that savings rate to go back up, but this is another worry to look at. Another chart I wanted to throw up is cash was okay, especially a real rate of return relative to inflation. But you can see cash is now, the yields keeps falling, and I expect that to even come down further. And what happens if it gets too close to the inflation rate? Well, you're not making a real rate of return. So a lot of people had cash was kind of a king, but I don't think it's going to be that anymore. And we've seen the spread between bond yields and cash beginning to widen. And I think that's just going to continue. Probably not. I just heard Mohamed El-Erian, the economist, come out. He thinks the 10-year is going to go back to 450, but short rates are going to continue to come down. So what does that mean? That if you're in cash, you're going to lose opportunity. You have opportunity risk. And you may need to get that money invested to stay ahead of inflation. Metals, everybody's talking about gold and silver. We had a big pullback in gold, especially silver. I think it dropped 30%. This is a comparison chart. This is showing the gold parabolic move from November 79 to March of 80. It was big. That's the gold line. And then you can see the darker line below it is the current one, and you can see it's stalled. So there's a diverging pattern between what happened. So there could be more upside for gold as if it moves in the same kind of magnitude we saw in 79 and 80. But gold is diverging right now, and we'll see how it shakes out as we move forward. I think there could be some more upside. And what I recommend to my advisors is don't buy it, but don't sell it. I'm not a gold, silver expert. I'm going to just give that up front. This is how big it's become. Wow. Gold has become as large as the U.S. stock market, X the Mag 7. If you take out the Mag 7, the 493 companies of the S&P 500 now, gold has reached a point where it's equal with the 493 companies. And you can see it's bigger than Asia. It's bigger than Europe's stock market. It's bigger than Bitcoin or Ethereum. You can just see how big it is. Well, when it gets that big, then there is potential for greater volatility and shock. All right, get the drum roll going, Eric. Here it is, our outlook for 26. We haven't changed much. We've been right on the extreme volatility. We expect that to continue. We've been right on resilient consumers, deflation, CPI retreat to Fed. That's on the way. We've had 4 months in a row of below expectations. We do think the Fed will continue to cut rates. Now, the labor may not be the reason. I'm adding inflation because I think inflation is going to come down so that they can continue their soft dovishness, maybe continue to do the 2 rate cuts. And if rates come down, of course, bonds will rally. I don't think they're going to rally that much, but I think they will rally somewhat as rates come down. And we are bullish on stocks. We see pullbacks, which we believe there will be, and weakness. There will be weakness as buying opportunities. And why? The catalyst is policy support, accommodative Fed, AI-driven productivity gains. And of course, another thing you can say is the earnings estimates are growing. So I do believe there's going to be a tug of war between value and growth stocks. Right now, value has the edge this year, but I think it's going to go back and forth. And so I think AI stocks will come back and begin to take leadership again, but it could be back and forth all year between growth and value. And of course, we always liked, so what are we saying for the total year? We haven't changed our outlook. We do expect an intra-year correction. That's 10% or more, which comes in line with Goldman Sachs probabilities. And then we're expecting by the year end, it's going to be a rough ride, Eric, but we end up 10 to 15% by the end of the year. Of course, we have the wild card. You could circle the Iran issues that may be unfolding here, but I don't think the Iran issue will, if we do attack Iran, it's going to impact the stock market much. Depends what they do. If they or they stop the shipping in the Strait of Hormuz, or if they stop or do something with oil, that could have a temporary impact on the market. Oil prices could rise quickly, but it's impossible to forecast how this will end up, what will happen. But overall, we expect a rough ride, but we expect to end the year higher when it all comes together.
Awesome. Thank you, Tom, as always, very much for your balanced look at everything, the positives, the headwinds, and kind of try to make sense of what that means for us moving forward. So really appreciate all your work that goes into these monthly updates. For those of you with us, I see a number of you out there today, so thank you for being here. You're invited to send any questions for Tom. I'll open up the call here for any questions. I'm watching text, so you can text our office number. I don't see any questions right there. You can also post it in the comments section. So if you're on, let's say, Facebook and you post it in the comments section down below, I will see it that way as well. I did get one email here. And he says, can you explain how you go about buys and sells of particular companies and positions in the different portfolios? So I'm sure there's a different answer for the different strategies, but can you give us some kind of high-level bullet points of how you go about making individual changes without talking about any specific companies? Because we're not supposed to be doing that on these calls.
Yeah. Well, we're not going to talk about any specific, but what we're for example, the wide mode portfolio. Now, there's different portfolios. We do have a durable dividend, super dividend. So we have different. Then we have the thematic. We got the fixed alt. they all use different approaches. With the wide moat, we look for companies that are Warren Buffett type companies that have enduring positivity relative to their peers, not just short term, but longer term. So we have a universe of wide moat, quote, companies that will hopefully dominate their competitors going forward, and that there's reasons for them being wide moat. They may have huge clientele that's sticky. It's going to be almost impossible to lose their clients fast, or they dominate certain areas. Let's say Coca-Cola, for example, that would be one that dominates, and they have the secret sauce in their Coke. So, and they have huge amount of name recognition. So there's a lot of things we look at, and then we try to diversify the portfolio so that we end up having companies in each of the sectors. Now, in the thematic area, we may tilt towards a particular theme for temporarily, but in the wide moat, we want to have representation from a number of sectors. And in our fixed alt, we're looking for, let's say in the alternative sector, we're looking for probably mutual funds, because that's where they have seemingly better strategies, multi-strategy approach that can end up achieving a volatility similar to bonds, but not so interest rate dependent. So, because if you're in bonds, it's interest rate dependent. If rates go up, your price goes down. If rates go down, then the price goes up. But there are other avenues of ways getting similar volatility characteristics, but you're not dependent upon interest rate movement. And so we have a number of strategies in that multi-strategy portfolios to do that, get a different return pattern than you get from just straight bonds. And then in thematic, again, we're looking for themes. AI is a theme. So we're going to be tilted towards AI-oriented ETFs, or that have some AI in it, or maybe a little more weighted that way, and maybe some other things like robotics or something like that. So we're always looking for themes, and that's more active. And then, in durable dividend, we're looking for companies that are financially sound, and they're able to hopefully continue their dividend payments. In other words, they've had a history of raising dividends, but also they're showing capacity to continue based on their fundamentals. And a lot of those companies in the wide moat are well-known names. They're great companies. Every once in a while, like we have certain companies, we have a couple companies in software, Eric, that got kind of hit that we weren't expecting, that AI disruption. I think it's overdone, and we'll reevaluate. We think there will be a recovery of few of those stocks. So but we are watching that, and we also look at what's going on in technicals. Is the companies showing relative to let's say the S&P 500? Are they showing some progress on their pricing? Because at the end of the day, everything ends up in the price of the security. So we're looking also at technical analysis.
So to summarize that answer, it's complicated.
It's complicated. Each strategy has a different approach.
And one-on-one, I can say one-on-one with anybody that has questions about that too. We can go a lot deeper with you and better understand kind of what you're seeing in your maybe it's something that you saw in your accounts, and we can go deeper into some of those changes and why in your particular accounts and your strategy and things like that. But I think that what you just explained is a good testament to the amount of work that you do behind the scenes, Tom, of looking at all these different filters and looking at the current environment that we're in, and just all of these different factors that go into building out a good portfolio and then monitoring it moving forward. So very good. I'll take another look here. I don't see any questions there in my email. So final opportunity, a couple of housekeeping items. For those of you that want to post another question, please do so quickly here, and I'll bring that to Tom. First of all, I will have this recording up on the website here this afternoon. If you're watching the recording, there's a ask a question button right here, and that question will come right to me, and I will get together with Tom, and we'll circle back with you at our very first opportunity. You'll also have the Cliff Notes version of today's message. So if you want the 2-page summary, you can download the summary here. Again, should have that up sometime this afternoon. Sometimes it takes until the next morning. So definitely by tomorrow morning. If you're not, I start not joining me each Monday. I start my week each Monday morning, 9 a.m. Central, with a brief update of what's happened in the markets and some things that we're looking for. Sometimes include some updates around the office, things to be aware of. So if you're not joining me, I invite you to join me on our website, on different social media pages, 9 a.m. Central Time. And then I send out an email with additional information and a link back to that video at 2 p.m. Again on Mondays. So if you're not getting that, you can subscribe at our website. And then just a heads up, we do have our next monthly call scheduled. It will be exactly a month from today. So Thursday, March 19th at 11 a.m. It is posted on the website. If you want to go drop in your email on this RSVP button, you'll get an email ahead of that meeting, ahead of that presentation if you'd like a little reminder. That's all that email does. So with that, I will look at my email one more time here, Tom. I don't see anything there. Nothing in our texts, and I don't see anything posted online. So any closing thoughts, Tom? Otherwise, I'll wrap us up.
I think just the theme this year is volatility, but we're expecting it to end well by the end of the year. So you need patience. And if you have money that could be invested, consider that if we do get a pullback. I think it will be a good opportunity to get back in or get more in going forward. Excellent. But work with Eric on that. He knows everything about your risk profiles.
Or if you're working with Dan or Rana, good reminder.
Yes.
So yes, any one of us, whoever you're working with, happy to sit down and re-review anything with you when you would like to do that. So don't hesitate to reach out. So with that, thank you, Tom. Thank you for everybody for joining us here today. If you're watching the recording, thank you as well for taking the time. That concludes this month's monthly Capital Markets Update and Outlook call for February 2026. Hope you guys all have a wonderful rest of your week. Bye, everybody.